Hey, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. Welcome to our YouTube channel. If you like this video, please give us a thumbs up. You can always hit the subscribe button as well if you want to be alerted for future videos. So we're going to start off with a chart with the S&P 500 going back some 30 years, back to 1990. And I've got the classic RSI 14. This is a daily chart. And what is very interesting is how few times RSI 14 dipped below 20. And I've marked these few times on the chart. You had one in 1990, you had one in 94. Then in the bear market, after the dot-com bubble burst, you almost got below 20 in 2000. You did get below 20 in 2001 and 2002. And look how long it took to recover there. And then in the financial crisis, RSI did not go below 20. So that was kind of interesting. But there we can see the European sovereign debt crisis in 2011. We went below 20. That little crash in August of 2015, RSI went below 20. And then in October and in December 2018, we had RSI going below 20. And of course, last week, RSI moved below 20. That's basically 1, 2, 3, 4, 5, 6, 7, 8 times. And then the one that happened last week was the 9th time. So 9 times in 30 years is a relatively rare event. And so what I did is I put this in Amy Broker to back test. You know, what if you bought when RSI moved below 20 and say sold when RSI moved above 50? Because I think the market has been broad-sided and is going to be choppy at best, bearish at worst. So let's see what that test looks like. So again, this is just a basic signal test. I'm looking to buy when RSI goes below 20 and then sell when RSI goes above 50. And there you can see the trades that we had here. And all of them were positive. So it is a profitable trade, but you can see the holding period is fairly short. Outside of that 8-week holding period, it tends to be 2 to 3 weeks. So it's a very short hold because it is a mean reversion system. And let's see what these trades look like on the chart. I can right click on this and then I can click show actual trades and then we can see what they look like here. So there is a signal and you can see we went lower after the initial signal and then bounced and got out. We had a low in December and then got out on that bounce. And don't try and curve fit this system. You're going to say, oh man, if you trailed or stopped, you would have had a great trade there. Well, you wouldn't have known that at that time because this is a mean reversion system and mean reversion systems typically take profits on bounces. And that's what happened in August, take profit on the bounce. And then if we look, see these signals are few and far between. So I'll stretch it out. There you can see in July 2011, oversold, and then you get out on the bounce. And then if we go, I have to go all the way back. There we go, 2001, you get the bounce. And in 2002, you get the bounce. So this is just a very basic mean reversion system. But I also wanted to go back and see what happened when RSI moved below 30 after a period of being in an uptrend, say above 70, and that initial move below 30. What happened after that happened in the S&P 500? So I ran these numbers not as a system, but to see how long it took from when RSI made that initial move below 30, which is still relatively rare over the past 30 years, and RSI then moved above 70, how many days were involved. And here are all the trades that you can see. You've got one on the 25th, so we really don't count that one. You know, if you traded the system, yeah, you would have a compound annual return of 4.25%, but the maximum drawdown was 52%. So it's clearly not a viable system. And that, of course, is because of the 2001, 2002 bear market. You're down 10%. And then the financial crisis, you had a 27% loss. Again, this is not a trading system. I just want to see what happens after RSI moves below 30. So I put all of these occurrences in a spreadsheet, and I'll show them on the chart here in a little bit. But you can see 26 times you had an initial move where RSI moved below 30. So it had been above 70 at some point, and then it had that shock where it moved below 30. And how long did it take to recover? And here we can see the number of trading days it took to get back above 70. And there, of course, is a 2001-2 bear market, and into 2003, 435 days. And there we can see the financial crisis, 2008, 2009, 382 days. But the average of all 26 occurrences is 103 days, roughly. Call it 100. So that tells me that the market has been blindsided, and I would think we would need at least 100 trading days. Sure, it ranges from a month to several months to over a year because these are trading days. So 100 days is about 5 months. But I would think it would take a couple of months at least for the market to recover. And so let's look at these individual instances and what happened. So we've got 3 complete instances in the last 18 months. There you can see RSI is above 70. That's the red arrow. And then when RSI moves below 30, that's the green arrow. And this is October 2018. And after RSI moved below 30, you traded sideways, then moved down, and then moved up. And you can see it was 1, 2, 3, 4 months or so before RSI got above 70. And when RSI gets above 70, that shows strong upside momentum. I don't really think of that as a overbought reading that is bearish. It shows strong upside momentum. Now, here's one of the shorter ones. You got RSI below 30 there at the end of May, and that was a bottom. That was just a sharp correction, and you got above 70 there in June. But then in August, you got below 30, and it took a couple of months to stabilize. So we're in a consolidation period. And then RSI got above 70 in November. And then if we look at now, the market has been broadsided, and the broadside is kind of like equivalent to what we saw in October. So this tells me I would expect a couple months of sideways trading now. And let's look at a few other instances on this chart, because we can just go back and see the arrows for the signals there. So here we can see RSI moving below 30 in the beginning of February 2018. And then we had a huge rally and then a test of the low. And overall, we had 4 to 5, maybe 6 months of choppy sideways trading. And RSI got above 70 back in August. So it took quite a while for a full recovery to happen. Then we look at a couple more instances. There we have RSI moving below 30 in August 2015, and we had pretty much choppy trading all the way until April. RSI gets above 70, and we start moving to new highs. And this is one of the shorter pullbacks. It's kind of like the one in May 2019 I just showed you, where you became below 30, oversold in early November, and then had that big advance and breakout, got above 70 quite quick. So if you can get above 70 really quick, maybe that is bullish. But the longer it takes to get above 70, that means you're in some sort of a corrective mode. So here's another short correction. This was in October, a very sharp decline, but this move below 30 marked the low, and you move right back above 70. So not all moves below 30 result in an extended choppy trading range or an extended bear market. But I'm looking at all of them, and I said on average it takes about 103 days to get above 70, which tells me you're going to have a few months of choppy trading. So here we have RSI moving below 30 in May 2012, and then it got back above in September. This is a bit of a choppy period because you got below 30 in November and then back above 70 a couple months later. Now here's July 2011. Look at that hit. And this compares to the hit we've just had. And look at how many months. We had 2 months, 3 months of really choppy trading. We got a breakout, but then a sharp pullback. So it was quite a few months before the market really caught its breath and got back on the upward track. And here's another one in 2010. That's the May flash crash there. And then you can see we moved to a new low and RSI moved below 30. But it took 1, 2, 3, 4 months of base building, bottoming process. And then you got the breakout and RSI above 70. So that's the takeaway. When RSI goes below 30, it means something has happened. There's been a shell shock to the system. And then you look at 2008, there's RSI moving below 30 in January, and it did not get above 70 until July 2009. So all these moves were showing not enough upside momentum to get above 70. They were bear market rallies. And, RSI, that 60 zone, that 50 to 60 zone is kind of a resistance zone when you're in a downtrend. So if RSI gets to that 50 to 60 zone, I would be more defensive than offensive. And show you a couple more from 2000. There we can see RSI moving below 30 in August, but that was after an extended decline, and then it broke out a couple months later. And then we can see this initial shock from a new high, RSI moving below 30, and we went to new lows. And then we got above 70 in May, but that proved to be a false breakout or whatever. And then we moved below 30 there in September 2001. And that, of course, is 9/11. So just one more thing on the current SPY chart. You can see there's RSI moving below 30 and even 20, RSI 14. And there you can see in October 2018. And then we had a choppy range as we bounced around the 200-day. And we're kind of doing the same now. A big move up on Monday, sharp decline on Tuesday, and maybe a big bounce on Wednesday. So it's going to be very choppy. But notice how RSI in November and December peaked in that 50 to 60 zone. And that's kind of the area to watch for resistance and a potential downturn after a bounce. So if RSI gets into that 50 to 60 zone in the coming days or weeks, that might be the cue to prepare for a leg move lower. So that concludes this video for TrendInvestorPro.com. Remember, if you like this video, please give us a thumbs up or consider subscribing. And you can always visit our website, TrendInvestorPro.com, for more information. Thanks very much for tuning in, and have a great day.